avoid a tax audit in China. Now, avoiding a tax audit in China or in any other jurisdiction should always be done within the bounds of legal and ethical practices. Attempting to evade taxes or engaging in fraudulent activities can result in severe penalties. So today, I want to provide you with some legitimate strategies to minimize the risk of a tax audit in China. The first one is compliance with tax regulations. The most effective way to avoid a tax audit is to ensure full compliance with all Chinese tax regulations. You need to regularly review tax laws and ensure that your business operations align with them. The second is hire a professional tax advisor. By employing a reputable tax advisor or accountant in China who is well versed in Chinese tax laws will help you to navigate the complexities of the tax system and ensure accurate filings. The third is accurate record keeping. Now, you have to maintain meticulous and accurate financial records in China. Keep all receipts, invoices, and documentation related to your business transactions, related to your expenses, as well as to your income. 4, timely tax filings. Ensure that you file your tax returns on time. Late filings can trigger audits. Create a schedule to meet all filing deadlines. And generally speaking, the tax bureaus will provide, by the end of each fiscal year, deadlines for their relevant taxes in terms of profits tax, value-added tax, consumption tax, etc. Number 5 is the transparency and reporting. Be transparent in your financial reporting. Avoid underreporting income or inflating expenses, as this can raise red flags with tax authorities. Number 6, avoid high-risk transactions. Be cautious with complex, high-risk financial transactions that might attract the attention of tax authorities. Seek professional advice before engaging in any such transactions. Get advice prior to actually initiating the transaction. Number 7, understand the tax deductions and credits. You need to familiarize yourself with allowable deductions and tax credits. Take advantage of legitimate deductions and credits to reduce your tax liabilities. Transfer pricing compliance. If your business is involved in international transactions within a corporate group, ensure that your transfer pricing policies comply with Chinese regulations in order to avoid disputes. Understand when documentation might be needed from a transfer pricing analysis by the tax authorities. Number 9, stay informed about tax law changes. Keep up to date within your industry and sector about the changes in the various laws and regulations. Tax authorities may introduce new requirements, and you need to stay informed so that you can adapt your internal processes and flows to meet those requirements. Number 10, tax planning. Engage in proactive tax planning to optimize your tax liability legally. Consult with tax experts to explore tax saving strategies that align with the Chinese tax laws. Number 11 is engage in tax audits preemptively. Now, in China, In China, year-end audits are not actually mandatory, although when you do your year-end profits tax filings, you will have to tick a box to indicate that your year-end audits have been completed. Be preemptive with your tax audits and your year-end audits. Some businesses choose to undergo voluntary tax audits to identify and rectify any potential issues before tax authorities do. This is a proactive approach that can help you avoid future audits, and you can do all of this within your year-end auditing. Number 12, maintain proper documentation. Obviously, ensure that all your financial documents are properly organized, stored, easily accessible in case of an audit. 13, seek professional advice. If you suspect any potential tax issues or are unsure about your tax compliance, consult with a tax expert who specializes in Chinese taxation and is on the ground and can actually mediate together with the tax bureaus. Number 14, good corporate governance. Maintain transparent corporate governance practices. This can help demonstrate that your business operates ethically and transparently. And last but not least, avoid red flags. avoid any sudden significant changes in your financial reporting that could raise suspicions. Consistency can reduce the likelihood of an audit. Now, just a tad bit of a case study. I have personally gone through a tax audit with my organization in Shanghai. The reason for the tax audit was that we were doing considerably better than most accounting firms within our industry and sector. And they wanted to come in to understand why we were doing better. Were we doing anything under the table to inflate our revenue? They would just came in to ask a lot of questions. It was a 3-month tax audit that obviously took a lot of time from the management, the financial team within the organization. Now, obviously, coming in and saying you've done so well, we need to investigate, does not help a lot of people, because usually tax bureaus will come in to investigate if you've done something wrong. But it's just to say that you've got to remain in compliance. And obviously, if we had had the proper transfer pricing documentation in place, it might have sped up the tax audit itself. Now, remember that tax audits can be extremely random. For example, ours was. So even if you follow all the rules, there's no guaranteed way to completely avoid the possibility of an audit. However, by following these legitimate practices, you can minimize the risk and ensure that you are prepared for an audit if it really does occur. Thanks for listening.